Our next couple slides are going to deal with a few situations you may see, so we'll prep you for them. First off, a stock surrender. This is a voluntary process in which a shareholder gives up their shares of a company's stock back to the corporation, often in exchange for cash, other property, or debt relief. The shareholder is generally required to recognize income, whether that be capital gain or loss, depending on the situation, from the surrender, which is the difference between the fair market value of the cash or the property received and the shareholder's adjusted basis in the surrendered stock. We got an example here demonstrating how this works. Well, we got shareholder A. Shareholder A owns 1,000 shares of company B with an adjusted basis of $20,000. That's $20 per share. Shareholder A surrenders these shares back to company B in exchange for $30,000 in cash. The shareholder would recognize a capital gain of $10,000 from the stock surrender, calculated as follows. Here we've got the fair market value of the cash received of $30,000, the adjusted basis of the surrendered stock, which is $20,000, and that is going to result in a capital gain of $10,000. So in this example, shareholder A would recognize $10,000 as income from the stock surrendered. This capital gain would be subject to tax with the rate depending on short-term, long-term, and then this is passed on to the individual, and we revert back to our individual income tax lessons. All right, looking good. Got an example here on stock surrender. Pine Corp, it's an accrual basis calendar year C Corp with 200,000 shares of voting common stock issued and outstanding as of December 28th, year 1. On Friday, December 29, year 1, Reed surrendered 4,000 shares of Pine stock to Pine in exchange for $45,000 cash. Reed had no direct or indirect interest in Pine after the stock surrender. Additional information is here, but let's read the question first. I always like to do that because some information may be a distractor. What amount of income did Reed recognize from the stock surrender? Great question. I'm glad you asked. Well, what is Reed's gain? It's the difference between the $45,000 in cash, as we saw in our previous slide. What cash did we receive? What value did we receive? And what was our basis? Our basis was $40,000. So kind of simple. What's the gain? What did we get versus what did we give up? So just gain of $5,000. We don't really care about Pine's accumulated earnings and profits. We don't care about their net operating loss. Read the question first. Think of a formula. Pick out that information. Don't let the question guide you. You guide the question. And now we have a stock redemption. This occurs when a corporation buys back shares of its own stock from its shareholders. The tax treatment of a stock redemption can either be as a sale or exchange of stock, which would result in capital gain or loss treatment, or as a distribution subject to dividend income treatment, depending on certain factors. Now, when a shareholder receives a proportionate distribution in redemption of stock, such as their percentage ownership in the corporation remains the same before and after the redemption, the distribution is generally treated as a dividend rather than a sale or exchange. Now, this is going to be because the proportionate distribution does not materially change the shareholder's interest in the corporation. In this case, the distribution will be taxed as a dividend to the extent of the corporation's E&P. Let's go through, and as in good tradition, we'll see an example. We got a scenario here. We've got Orchid Corp, a C Corp with $50,000 of E&P. The corporation has two shareholders, Alice and Bob, who each own 5,000 shares, representing 50% ownership each. The corporation decides to redeem 1,000 shares of stock from each shareholder. So before the redemption, they each had 5,000 shares, which is 50% of the ownership. Total shares were 10,000. After the redemption, they each have 4,000 shares each, but that's still 50% ownership. It's kind of skimming a little off the top for each. Doesn't change the ownership percentage, and that's all that matters. How many shares you have doesn't matter. It's about what percentage you have. And if you're an investor, let's say a big-time investor, that is what matters, is your percent ownership. As the redemption is proportionate with respect to both Alice and Bob, their percentage ownership in Orchid Corp remains the same after the redemption. Therefore, the distribution in redemption of stock will likely result in dividend income treatment for both of the shareholders. Assume the fair market value of the redeemed shares is $20 per share, making the total redemption value $20,000 for each shareholder. That is going to be the $20 times 1,000 shares. And since the corporation has $50,000 of E&P, the distributions to both Alice and Bob will be taxed as dividends. Thinking back to our distributions, see all the rules? You got to always have all the rules that we've learned on your mind at all times. It is exhausting, I know. Each shareholder would recognize $20,000 as dividend income, which would be subject to the applicable tax rates on their personal return. Here's a nice little graphic. This will be on our memorization guide as well. Just here if you want to kind of take a look, help you memorize some of the key points that we've seen. Not going to go through this because that would just be a recap of what we've seen, but feel free to take a look and knock it out. All right, we'll wrap it up with a good summary and call it a day on this lesson. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.